Hey everyone, welcome back to SHY ETF. Today, we're diving into the world of bonds with a specific ETF in mind, the PULS ETF, or the PGIM Ultra Short Bond ETF. Now, bonds generally aren't known for being the most exciting investment. But hear me out. This ETF focuses on a specific type of bond, ultra-short-term bonds. We're talking about bonds with maturities of less than 3 years, often within a year. The question is, can this super conservative approach actually help you earn some income? And is it the right fit for your portfolio? We'll be cracking open the PULS ETF, analyzing its risks and rewards, and exploring some alternative options. So, buckle up and hit that subscribe button if you're ready to learn more about the PULS ETF and the world of ultra-short-term bonds. Let's chat. Question 1. What is PULS ETF? PULS ETF, which stands for PGIM Ultra Short Bond ETF, is an exchange-traded fund, ETF, designed to invest in ultra-short-term bonds. Here's a breakdown of what that means. Exchange-traded fund, ETF. Imagine a basket containing various individual stocks. An ETF functions similarly, but instead of stocks, it holds a collection of bonds. This basket is constantly traded on a stock exchange throughout the day, just like a single company's stock. This allows investors to buy and sell units of the ETF easily, similar to buying a stock. Ultra-short-term bonds. Bonds are essentially IOUs issued by governments or companies. The issuer promises to repay the principal amount you loaned, along with interest over a specific time frame, maturity. Ultra-short-term bonds have maturities of typically less than 3 years, often even shorter, within 1 year. This means you get your money back relatively quickly compared to longer-term bonds. Investment objective of PULS ETF. The primary goal of PULS ETF is to provide investors with total return, which combines 2 sources of income. Current income. This comes from the interest payments made by the underlying bonds held within the ETF. Capital appreciation. Ideally, the price of the PULS ETF itself will increase over time, allowing you to sell your units at a profit. Key points to remember about PULS ETF. Focus on investment grade. PULS ETF primarily invests in investment grade bonds. These are bonds issued by entities with a high credit rating, indicating a lower risk of default, failure to repay. Active management. Unlike some ETFs that passively track an index, PULS is actively managed. This means a team of portfolio managers make decisions about which specific ultra-short-term bonds to buy and sell within the ETF. Potential benefits. PULS ETF can offer several advantages. Reduced volatility. Since ultra-short-term bonds have less sensitivity to interest rate changes compared to longer-term bonds, PULS ETF may experience lower price fluctuations. Enhanced cash management. PULS can be a way to potentially earn a higher return on your cash compared to a traditional savings account. Portfolio diversification. Including PULS ETF in your portfolio can add diversification, which helps spread out risk across different asset classes. Things to consider before investing in PULS ETF. Lower returns. Generally, ultra-short-term bonds offer lower potential returns compared to longer-term bonds. Interest rate risk. While interest rate fluctuations may have a smaller impact on PULS ETF than on longer-term bond funds, rising interest rates could still cause the price of the ETF to decrease. Management fees. Since PULS is actively managed, there are fees associated with the portfolio management team's activities. These fees can eat into your returns. Question 2. What is the investment objective of the PULS ETF? The investment objective of the PULS ETF, or PGIM Ultra Short Bond ETF, is to achieve a total return for investors. This total return is a combination of 2 main components. 1. Current income. this refers to the interest payments that the PULS ETF generates by holding underlying ultra-short-term bonds. When you invest in a bond, you essentially loan money to the issuer, government or company, for a specific period. In return, the issuer makes regular interest payments to you throughout the life of the bond and then repays the original amount you invested, principal, at the maturity date. The PULS ETF collects these interest payments from all the bonds it holds and distributes them to its shareholders, providing a stream of current income. 2. Capital appreciation. This refers to the potential increase in the price of the PULS ETF itself over time. Unlike individual bonds that have a fixed maturity date and return your principal, the price of an ETF, like PULS, can fluctuate in the market. Ideally, the combined effect of these fluctuations would be an increase in the price per share of the ETF when you sell it compared to what you paid when you bought it. This price appreciation would contribute to your total return. Here's a deeper dive into how PULS ETF aims to achieve this objective. Focus on ultra-short-term bonds. The ETF primarily invests in ultra-short-term bonds, typically with maturities of less than 3 years, often even shorter, within 1 year. This focus on shorter maturities has several implications. Reduced interest rate risk. Bond prices generally have an inverse relationship with interest rates. When interest rates rise, existing bonds become less attractive compared to newer ones with higher interest rates. This can cause the price of older bonds to decrease. By focusing on ultra-short-term bonds, PULS ETF aims to minimize this risk because shorter-term bonds are less sensitive to interest rate fluctuations. Lower potential returns. Typically, the shorter the maturity of a bond, the lower the interest rate it offers. So, while PULS ETF aims for consistent income through these bonds, the overall return potential might be lower compared to funds that invest in longer-term bonds. Active management. Unlike some ETFs that passively track a specific bond index, PULS ETF is actively managed by a team of portfolio managers. These managers have the discretion to select which specific ultra-short-term bonds to include within the ETF. Their goal is to choose bonds that offer a balance between potential returns and credit quality. Question 3. How does the PULS ETF achieve its investment objective? The PULS ETF, or PGIM Ultra Short Bond ETF, achieves its investment objective of total return through a two-pronged approach. 1. Generating current income through ultra-short-term bonds. Investment strategy. PULS primarily invests in a portfolio of investment-grade, US dollar-denominated, ultra-short-term fixed income instruments. These instruments can include Treasury bills, short-term debt obligations issued by the U.S. government with maturities of less than 1 year. Commercial paper, unsecured, short-term debt obligations issued by corporations. Money market instruments, short-term debt instruments issued by various entities, such as certificates of deposit, CDs, and commercial paper. Asset-backed securities, ABS. These are financial instruments that pool together short-term debt obligations like car loans or student loans, and then sells them as a security. Focus on short maturities. The key aspect is the focus on ultra-short-term maturities, typically less than 3 years and often within 1 year. This strategy benefits the income generation in a few ways. Reduced interest rate risk. Bond prices generally have an inverse relationship with interest rates. When interest rates rise, existing bonds become less attractive compared to newer ones with higher interest rates. This can cause the price of older bonds to decrease. By focusing on ultra-short-term bonds, PULS minimizes this risk. Since these bonds have maturities approaching very soon, even if interest rates rise, the investor gets their principal back quickly and can reinvest at the prevailing higher rates. Frequent reinvestment. Shorter maturities mean the underlying bonds in the ETF mature and are reinvested more frequently. This allows the portfolio managers to capture the prevailing interest rates in the market and potentially increase the overall income generation for the ETF. Distribution of interest payments. The PULS ETF collects the regular interest payments made by these underlying bonds. These payments are then typically distributed to shareholders on a regular basis, often quarterly, providing a stream of current income for investors. 2. Potential for capital appreciation. Price fluctuations. Unlike individual bonds with a fixed maturity date and return of principal, the price of an ETF like PULS can fluctuate in the market. These fluctuations are influenced by various factors, including supply and demand for the ETF, overall market conditions, and changes in interest rates. Price appreciation goal. Ideally, the combined effect of these fluctuations would be an increase in the price per share of the ETF when you sell it compared to what you paid when you bought it. This price appreciation would contribute to your total return on the investment. Active management strategy. It's important to note that PULS is an actively managed ETF. A team of portfolio managers makes decisions about which specific ultra-short-term bonds to buy and sell within the ETF. Their goal is to select bonds with a balance between potential returns and credit quality. Since shorter-term bonds typically offer lower interest rates, the managers might choose bonds with slightly higher credit risk, issued by companies with a lower credit rating, to potentially earn a bit more income. However, they would do so while maintaining an overall focus on investment-grade bonds to minimize the risk of default. Manage interest rate risk and reinvestment opportunities. The managers can strategically choose bonds with different maturities to manage interest rate fluctuations and potentially capture better reinvestment opportunities as bonds mature. Question 4. What are the fees associated with investing in the PULS ETF? There are two primary types of fees associated with investing in the PULS ETF, PGIM Ultra Short Bond ETF. 1. Expense ratio. Definition: the expense ratio is an annual fee expressed as a percentage of the ETF's assets. It covers the ongoing costs of operating the ETF, including management fees paid to the portfolio managers who oversee the selection and maintenance of the underlying bonds within the ETF. Administrative fees that cover the costs of daily operations, such as record-keeping, legal and audit fees, and exchange listing fees. Other operational expenses associated with running the ETF. PULS expense ratio. The PULS ETF has a relatively low expense ratio compared to some actively managed ETFs. According to PGIM, the issuer of the ETF, the expense ratio for PULS is currently 0.15%, as of April 25, 2024. This means that for every $10,000 invested in the ETF annually, you would pay $15 in expense fees. Importance. While 0.15% may seem like a small fee, it's important to consider the impact of fees over time. Especially in an ETF like PULS, which may generate lower overall returns due to its focus on short-term bonds, keeping expense ratios low can help preserve your returns. 2. Brokerage commissions. Definition: these are fees charged by the brokerage firm you use to buy and sell shares of the PULS ETF. These fees are not specific to the ETF itself, but rather a general cost of using a brokerage platform to execute trades. Types of brokerage commissions. The specific commission structure can vary depending on the brokerage firm. Some common structures include flat fee, a fixed fee charged per trade, regardless of the number of shares purchased or sold. Percentage-based fee, a fee calculated as a percentage of the total trade value. Combination, some brokers might offer a combination of flat fees and/or minimum commissions. Impact on investors. it's important to compare commission structures offered by different brokers before investing in PULS or any other ETF. Lower commission fees can help you keep more of your returns. Some brokers may even offer commission-free ETF trades. Additional considerations. Transaction costs. There might be additional transaction costs associated with buying and selling shares of the PULS ETF within the secondary market. These costs are not directly charged by the ETF itself, but can arise from factors like bid-ask spreads, the difference between the highest price a buyer is willing to pay and the lowest price a seller is willing to accept for a share. Tax implications. Depending on how you hold the PULS ETF, e.g., in a taxable account or a retirement account, there might be tax implications associated with any dividends you receive or capital gains you realize when you sell your shares. Question 5. How does the PULS ETF handle dividends? The PULS ETF, PGIM Ultra Short Bond ETF, typically distributes dividends to its shareholders on a regular basis, often quarterly. Here's a breakdown of how PULS handles dividends. Source of dividends. Interest payments. The primary source of the dividends distributed by PULS comes from the interest payments that the underlying bonds within the ETF generate. As mentioned previously, PULS invests in ultra-short-term bonds. These bonds make regular interest payments to the ETF, which then collects these payments. Frequency of underlying payments. The frequency of these interest payments from the underlying bonds can vary depending on the specific bond. Some bonds might make monthly payments, while others might pay quarterly or semi-annually. PULS ETF's distribution policy. Distribution frequency. While the underlying bonds might have varying payment schedules, PULS typically distributes these collected interest payments to its shareholders on a regular basis, often quarterly. This provides investors with a predictable stream of income. Distribution options. Some ETFs offer investors the option to choose how they want to receive their dividends. For example, they might offer the option to reinvest the dividends back into the ETF to purchase additional shares, dividend reinvestment plan or DRIP, or receive the dividends in cash. PULS ETF specifics. Current distribution policy. According to publicly available information, PULS currently seems to distribute all the collected interest payments to shareholders as cash dividends. There is no mention of a dividend reinvestment option. Importance of checking latest information. It's important to note that ETF distribution policies can change over time. It's always best to consult the latest ETF fact sheet or prospectus directly from the issuer, PGIM in this case, to confirm the current dividend distribution policy for PULS. Tax implications of dividends. Taxable income. The dividends received from PULS are typically considered taxable income for investors holding the ETF in a taxable account. You will need to report these dividends on your tax return. The specific tax treatment can vary depending on your tax bracket and other factors. Impact on investors. Understanding dividend strategy. Knowing how PULS handles dividends is important for investors to understand the potential income stream they can expect from the ETF. For some investors, the regular cash dividends might be a valuable feature, especially for those seeking current income. Tax considerations. Understanding the tax implications of these dividends is crucial to assess the overall return you might receive after accounting for taxes. Question 6. What are the primary risks associated with investing in the PULS ETF? While PULS ETF offers potential benefits like steady income and lower volatility, there are inherent risks involved. Here's a breakdown of the primary risks to consider. 1. Market risk. Definition. Market risk refers to the possibility that the overall stock market, or the specific bond market in this case, could decline in value. This could cause the price of the PULS ETF to decrease as well, resulting in a loss for investors if they sell their shares at a lower price than they bought them for. Impact on PULS. Even though PULS focuses on ultra-short-term bonds, which are generally less sensitive to interest rate fluctuations compared to longer-term bonds, they are still not entirely immune to broader market movements. Economic downturns or negative market sentiment can still cause the price of the ETF to decline. 2. Credit risk. Definition. Credit risk refers to the possibility that an issuer of a bond, government or company, defaults on its debt obligation. This means they might not be able to make the promised interest payments or repay the principal amount at maturity. PULS and credit risk. While PULS primarily invests in investment-grade bonds with a lower risk of default, there's still a chance that some issuers could face financial difficulties and default. The impact of defaults would depend on the specific bonds involved and the overall portfolio diversification within PULS. 3. Liquidity risk. Definition. Liquidity risk refers to the difficulty of buying or selling an investment quickly and at a fair price. While ETFs generally trade on exchanges throughout the day, there's a chance that PULS might experience lower trading volume at times. This could make it harder to buy or sell shares quickly, especially if you need to exit your investment urgently. Considerations for PULS. The liquidity risk for PULS might be slightly higher compared to some very popular ETFs that trade with high volumes. However, since PULS focuses on underlying bonds with short maturities, the ability to exit the investment by waiting for bond maturities could mitigate this risk to some extent. 4. Interest rate risk. Definition. Interest rate risk refers to the impact of changes in interest rates on the price of bonds. Generally, when interest rates rise, the price of existing bonds tends to fall. This is because new bonds issued will offer the higher prevailing interest rates, making older bonds with lower interest rates less attractive. PULS and interest rates. While PULS focuses on ultra-short-term bonds to minimize interest rate risk, it's not entirely eliminated. If interest rates rise significantly, it could still cause the price of the ETF to decrease slightly. However, the shorter maturities of the underlying bonds would help mitigate this risk to a greater extent compared to longer-term bond funds. 5. Expense ratio. Definition. As discussed previously, the expense ratio is an annual fee that covers the operational costs of running the ETF. Impact on investors. While PULS has a relatively low expense ratio, these fees do eat into your overall returns. Especially in an ETF like PULS, which might generate lower potential returns due to its focus on short-term bonds, keeping expenses low is crucial to maximize your returns.